Welcome to the Froggy Five. I'm Jim Freilich, your host, founder and managing member of Froggy Companies. And I'm happy today to be meeting here with Axel Ragnarsson from Aligned Real Estate Partners. I've known Axel now 5 or 6 years. Met him at a meetup down in Portsmouth, multifamily meetup. He's wise beyond his years. We think of him as a Granite State real estate rock star, really. That's what. not to be too much of a sycophant to you, Axel. He's in between the ages of both my sons. I was surprised how young he was when I first met him, and did a small deal with him. He actually helped us with a piece of property. We took out a private loan years ago, and he has been scaling and doing things since. He's a founder and managing partner of Aligned Real Estate Partners. He's a founding partner for vertically aligned Blue Door Living. They got over 300 doors. I think he's been GP on 450 or more units across mainly New Hampshire and Florida, but he's also done deals in Texas and Indiana. And he's been involved in real estate for a long time for his age, for sure, and is just does everything top notch. So, Axel, I'm happy to have you here today. I'm a big fan of yours now.
Appreciate the invite, Jim. Thanks again.
Yeah. So tell us how you got started.
Yeah, it was back in college. So I grew up in New Hampshire, grew up in Southern New Hampshire. Always been interested in business. I was like that kid who was trying to sell the baseball cards at recess. So always kind of had that entrepreneurial bone. And late high school, early college, I was buying and selling cars. So that was kind of my income source, my side gig or hustle or whatever it's called nowadays. But did fairly well doing that, and enough, generated enough money and dough to where, I wanted to get into flipping something larger, right? And I think I just liked the HGTV house flipping shows, and decided I wanted to learn more about real estate. This is back in 2015 or so. Just went out and got my real estate license because I thought that'd be a good idea. I got it when I was like 19 years old. It was, just summer between a couple of years of college. So I got that, started working, just selling small single family homes with a broker in my college town, and made a couple bucks doing that while I was still doing the buying and selling of cars. And then I got to the point where I was like, all right, let's figure out how to actually go out and buy a piece of real estate. So found the websites like Bigger Pockets, started listening to that podcast, a bunch of different podcasts. But as I started learning about flipping houses, I started learning more about rental real estate and multifamily real estate and the idea of passive income. And I realized that that's kind of what I wanted to focus on, was going out there and building a portfolio of cash flowing real estate versus being transactional on the flipping houses side. Mm-hmm. So had an internship at the time and met a private money lender, and just through that internship by chance, and started going out there and looking for small multifamily properties kind of throughout New Hampshire. And one thing leads to another, bought a small 3-unit building, and that deal went okay. It wasn't really a grand slam or a bad deal. It was just an okay deal. Learned a ton on it, but had everything lined up as it related to money, at least in the short term, for getting deals financed. And the one thing that I realized that I could really compete on, or that I could outcompete other folks with, was just the desire and the ability to go out there and be really intentional about finding deals. So a lot of cold calling, a lot of direct mail, a lot of direct emailing, texting, messaging for rent ads, to trying to get in front of sellers. And that became my special sauce, I guess, as I define it, was being able to find killer deals. So from 2016 to 2020, I was just doing deals with my own money, using private financing, refinancing out of private debt into commercial financing, kind of built a portfolio that I personally owned and controlled of 60, 70 units throughout New Hampshire at the time. And 2020 rolled around, and I kind of had a moment where I was like, what do I want to really do with the business here? Is this what I want to do in perpetuity? Do I want to go and raise money? Do I want to try and do bigger deals? And I realized that for me, in order to capitalize on the deal flow that I had, in order to continue growing the business the way that I wanted to, I had to go out there and raise some money and start working with partners and investors. So between 2020 and 2022, it's really where that kind of shift occurred in the business. That's technically when I started Aligned Real Estate Partners, the business I'm running now. And we started doing slightly larger deals, a higher volume of deals. And then we bought some deals in other markets, such as Florida, and co-GP'd some deals in markets like Texas and Arizona. tried a bunch of different things, realized that I actually really enjoyed just raising money for my own deals, finding my own deals, managing and operating my own deals. New Hampshire's a great market. There's this level of comfort in doing deals in New Hampshire that I appreciated. And I've since, at 1.78 years ago, I moved to Boston, and, New Hampshire being an hour away, it made it easy to go up there and actually run the business and to look at properties, all that. So 23 kind of reshifted the focus to, we're going all in on New Hampshire. And really from 22, 23 to now, we've been buying anywhere from 100 to 175 units a year or so in New Hampshire. A lot of these small to mid-sized deals that are 5 to 50 units, we manage them in-house with the management company that I'm a partner in. And that's really what the business is today, is raising investor capital to buy kind of small deals, mostly direct to seller. And then we manage them in-house, and we like to think we operate them well. And that's what it looks like it's going to be, into the future here, or at least for the next few years.
Yeah. Well, I've been lucky enough to watch you from the side. I think before you started doing these syndications, I gave a small presentation at our multifamily get together on syndications. I use you as an example for the future. I'd like to think I planted a seed there. I want to take some credit here. And likewise, I took a private loan out through a guy you lined up, or however you lined it up, back on a piece of property that popped up here, 7 acres, a long time ago. And we transacted on that. I ended up gifting that to my youngest son when he got married. Now I got 3 grandkids over on that property. So thank you for that deal, Axel.
Love it.
Got us that money quick when we needed it. So this journey, like, is there any specific thing you've had to persevere through in these years when you've made that transition that you'd like to share?
Yeah, there was two individual deals that were pretty catastrophic. So, you can lose money investing in real estate, and people forget. The third deal I ever did was a duplex in Dover, New Hampshire. It was an auction deal. I had owned 2 properties before that. I had 2 3-unit buildings. 22. You're just dumb, naive. I think I got this figured out. Like, I look back, I'm like, dude, what were you thinking? But at the time, I was like, this is a beautiful neighborhood. I bought it, and I still think I bought it at the right price. But I made every mistake as it came to turning that deal around. Hired the wrong GC, wrong reno plan to begin with. Just didn't manage it diligently. Assumed that everybody was going to do their job when GCs, need a very high level of babysitting and oversight. It was just a lot of different mistakes. And then the timing was terrible. I bought it in 2019. As I'm going to sell it, COVID hit, the entire real estate market shut down. And I got smoked. I got absolutely smoked on that deal. Had very high interest, hard money on it. And I had to sell the other 2 properties that were great deals that I had a lot of equity in, that were performing very well, to get out of the loan of that deal. So I went from, and I had another deal that I bought at the time that I also had to basically flip instead of hold. So I was up to 3, and then I went back down to 0. And I felt like I had just wasted 2 years of my time in terms of growing the portfolio. So, that deal was a total whiff, right? And obviously I learned a ton of lessons on that and took those lessons to go apply on the next ones. And then I did a deal that was just with my own capital. That was a step up. It was a 23-unit deal. And it was the wrong business plan. It was the wrong neighborhood. I bought it in the wrong market, paid the wrong price, had the wrong property managers, a lot of similar mistakes, just at a higher level. And I had to sell that one. And then I had to sell a few other properties to get out of that deal. So, I've probably done 60, 70 deals since being in the business. Only 2 of them were bad, but they stung really, really bad at the time. And that the second deal that I'm talking about here, I finally got out of that one in 2023, and I bought it in 2021. So in general, they haven't been like catastrophic in the sense that they sent the business to 0 and they were like permanently crippling. I just had to, get out of some other assets. But in general, the way that I look at it is I was okay with being very aggressive with pursuing deals because of the fact that a lot of what we were doing were hairy deals direct to seller with a ton of potential margin. And 9 out of 10 of those deals go extremely well. I should say 8 of them go extremely well. One of them is maybe, and then maybe one of them is a little bit more problematic. And that was just kind of the risk that I was willing to accept, being a young person, putting my own capital at risk and understanding that, if I'm going to be buying these deals at 25, 30% below market value, but the price that I'm paying to do, the risk that I have to accept in order to do so is I can't really walk all of those units during due diligence, or the seller has to close quickly, or I have to kind of use an aggressive debt product to get that financed. Well, that's okay, knowing that in the aggregate, the returns I'm pursuing and achieving are going to account for that risk and compensate me for that risk. Now, over time, that's shifted as we've started raising money. I'm not taking these types of risks when we're raising LP capital. Raising LP capital to buy deals with quality debt where we can do effective due diligence, where we can mitigate a lot of that risk. And that's been a bit of a shift in the business. But from a perseverance standpoint, it was, the easy answer to your question is doing a couple of tough deals that we're take 3 steps forward and then we took 1 step back temporarily type of situations. But you're going to do bad deals if you're in this business for a long enough period of time. And now I've been in it for 8 years. I mean, it's a lengthy period of time. I've been in it full time for 8 years. And it's irresponsible to think that at least one of them isn't going to go according to plan, right? I mean, that's just the nature of being in it.
Sure. Absolutely. Thanks. So, and you still were able to afford living in Boston, didn't have to move back to New Hampshire, right?
For the first 4 years down there, I was with 4 guys in an apartment, right? You figure out how to stretch $1 from a rent standpoint.
There you go. That was a wise decision. A lot of people make the migration permanently from New Hampshire to Boston. It's mostly the other people coming the other way. We just sold our 24th lot, and more than half of those people are coming up from Massachusetts to here. Well,
it makes sense to go the other way. There's not a lot of logical reasons you only do it if you're in your early 20s and you want to head down there and you want to have some fun.
You want a little action. At some point,
you come back up.
Yeah. You want a little action. You're not raising children yet. So,
exactly.
So within that, since we're on the subject of these 2 tough deals, I'm going to ask you to dive even deeper on maybe one of them, or in general, something, because you also have this property management side. Maybe that's a good area to choose something from, with the, having to manage these assets that are in different locations. I'm just looking for a very specific warning you might be able to give to listeners about, like, something you learned and you're like, okay, I'm not going to do that again. I learned it the hard way.
Yeah. There's a few that come to mind here. If I'm going to boil it to one,
could be a few.
I'll give you 2. I'll boil it down to the 2 probably biggest ones, right? You really, really need to understand the location and the submarkets and not just like, oh, this city is nice. You need to understand the submarket, so the zip code within that overall metro or that city. And then you need to understand within that really what's going on at the street level from a location standpoint, and specifically how that relates to the business plan of the property that you're buying. The deal that I did, this was a deal in Indianapolis. Didn't know the market that well, thought I did, drove it a few times, spoke with other people in the marketplace to get a sense of it. And I thought that I was in a B- area, but in reality, I was in a C area. So the business plan that we had for the deal was taking a C property, turning it into a B. Mm-hmm. But we weren't going to be compensated by the marketplace for doing that. And what I mean by that is tenants weren't going to pay the rents that we needed to pay. And we were taking on far too much construction risk doing that for the potential payoff. So location matters. We all understand that, but it matters even more so as it relates to what you're planning to do with the property. If you buy a crappy building in a crappy area, but you don't plan to do anything with it, okay, well, you can probably still have some challenges. You may have misunderwrote your vacancy or your expenses or something like that. But if you're not planning to try to turn over the tenant base and invest a lot of CapEx dollars, that's probably not as challenging of a situation. It becomes a much more challenging situation if you're compounding buying in the wrong area with over improving the property and a business plan that doesn't make sense. Those 2 things, it's like pouring gasoline on a fire, which is what happened there. The other big takeaway that I'll share that I think is consistent across everything, that we do now, you're only as good as the people that you're working with in your team, which is what, that's why we started a management company. That's why I've kind of focused back in New Hampshire, is like I can control every component of the team, which is very helpful. But for example, I'll use the Dover one, right? Hired the wrong GC. We hired a GC who was very experienced in doing apartment renovations, kind of low to mid-end apartment renovations. So like the LVP and the off the wall or off the rack cabinets at Home Depot type of kitchen, not moving walls around, not doing framing, just kind of very simplistic $10,000 to $20,000 apartment renos. And that's who I hired to go and do a pretty high end finish in this property in Dover, right? Where we're going in there and doing a granite stainless white shaker cabinet, move the floor plans around, gut the bathroom, putting hardwood down. We were finishing the basement that was an approved unit, so we were putting insulation, drywall, all that up, just way above their pay grade, way above what they had experience doing. They got overwhelmed. They did shitty work. Their subs and their guys weren't equipped and ready to do that type of work, and we had to do a lot of it over again. And you can apply this to any different number of situations, whether it's the property management company you're hiring, whether it's the broker you're hiring, whether it's the attorney you work with. You have to work with really quality people, and that's going to cost you more money. But there's the reason that it costs more is because there's a higher guarantee of results and typically positive results. And that's something, I think a lot of business owners or real estate investors go through this. It's certainly something that I went through, where you're so afraid of separating yourself from every dollar, which you should be. You have to be really focused about that. But oftentimes it just drives you to making poor decisions from a hiring, from a partnership, from a personnel standpoint, which compounds and costs you way more on the other side. And it's like every business owner, I think, implicitly knows they're not supposed to do that, but they end up doing it anyways. And then they end up learning it the hard way. It's like one of those, like you kind of have to touch the stove while the heat's on type of thing. And, and I learned that twice, because it happened again happened on that first deal, happened again on the second one as it relates to the PM company that we worked with on that one. That's probably the two critical, I think, takeaways that I took from those.
Those are great warnings. Those are great warnings. A few things come to mind related to that. So when I was underwriting deals for Permanis, I think when looking at apartments, this is for ground up too, relating back to your submarkets point, I would come in with comps, and then we, COO at the time, CEO, CFO, we had these conversations, and the CFO for Permanis, Eric, would say, what about these? What about these apartments over here that are from? And I would say, initially, I'd be like, well, that's not a comparison. I mean, those aren't as good as what we're going to do over here. He's like, there's people here. People can go rent those apartments. Yeah. Those are still your comps, right? You can't ignore. So I think one of your main points is you can't ignore the comps of what's really happened in the situation. You can't think that you could just go class D to C or C to B or B to A and turn it. And now all of a sudden the magnet's going to come there because it's some kind of gentrification. So that's a valuable.
As an aside, something that I've learned more and more after being in this business. Price is the best amenity for any potential resident. You're like, if I do this and the floor plan looks like this, and we use these finishes and we have this, we have a gym or we have whatever, it's like, okay, that's cool. But price is still the best feature of an apartment at the end of the day for 90% of residents throughout all classes.
Absolutely.
We start to separate from price, even up all the way to the tip top of the Class A section or Class A segment. You have to be in like 7 markets throughout the country. You have to be like downtown New York, downtown LA, downtown Boston, where it's becoming as much of a status symbol as it is an apartment. But still, like the vast majority of people, even people who are going around renting $4,000 one beds in Boston, like they'll still move if they can find a place that's a couple $100 cheaper. It's not that big of a deal if there's one less kitchen cabinet in the kitchen, or if the gym's a little bit smaller, because nobody uses any of the amenities in any apartment buildings anyways. It's one of the funniest components of apartment renovations, value-add business plans, ground up, is amenities are just, they're there for the leasing tour. No one really uses them. And people just care most about price and location. Those are the two. Everything else is like, there's a chasm, and then you get into all the other stuff that matters. But it's easy to forget that when you're getting all excited about a potential deal, and you're like, I think if we use this finish, we can you might be able to squeeze another $30-$40 a month in rent. If you're in the Class C space and it's another 2 or 3% in terms of an increase on, if you're trying to get that from 1,500 to 1,550 because you're thinking about doing these types of finishes, that you oftentimes find yourself in a tricky spot once you actually get into the deal, because people don't care about it as much as you do on the front end when you're underwriting it.
So the construction management and the property management, so key. So I don't know if you know Brian Davis, or he goes by G. Brian Davis. He writes a lot on Bigger Pockets and other stuff. He runs Spark Rental. And I interviewed him. He's 2 interviews ahead of you in the queue in terms of being uploaded. And he said, in his many years doing property management, and now as an investor, thousands of thousands of doors, thousands of deals. Every deal that he's seen go wrong, it's always been either property management or construction management. Like
Yeah.
these are the two main things that, and the nuances you pointed out are so critical. They can be so easily missed in terms of finishes and how much you're going to spend and pricing yourself into another category. But I won't belabor it too much, but I've definitely learned those the hard way as well. I want to shift gears a little bit because you're young and on the edge of technology. I know, like you got this, your website's sharp. Your wealth, what's it? Multifamily Wealth Podcast is like
Yep.
top end. So I know you got your finger on the pulse of technology at some level, even though ironically your bread and butter is being on the street and knowing how to do things. But I'm going to ask you, with what you're seeing these days, or how you're operating your business and working with Peter, who's super sharp and young as well. Like, what do you think about technology? Like, what's a big technology you're either using, something you're doing with technology to help your job become easier, or something you see that might be disruptive to the industry?
It's a great question. I think my mind immediately goes to what we're doing on the property management side. I think property management, in terms of getting face-to-face with residents and operating buildings, is the components of the real estate business that's going to be disrupted soonest by technology. I mean, it already has been over the last number of years. But when we think about raising capital, underwriting, et cetera, doing deals, raising money, that stuff is hard to automate, right? It's obviously hard to automate the process of identifying value add opportunities within a building or getting in front of another buyer or underwriting that effectively. Like, yeah, maybe underwriting, you have your financial inputs and then it spits out some kind of projected returns. That stuff will probably be automated. But deal making, raising money, establishing partnerships, that stuff is still, technology hasn't really disrupted that. But as it relates to property management, which is a much more systematized, process oriented, and automated business in general, that's where we're seeing a lot of help there. So a couple of things that come to mind. We use a platform called Notion, which is basically an information hub. It's a store for information. That's where we have like our knowledge base, right? All of our how-to videos in our property management company. That's where we store all of our documents. That's where all the information for our properties lives, in addition to our property management software. And Notion is a company that is very quickly leveraging artificial intelligence. So, for example, something that we can do there is, you're in the dashboard and you're a new hire in the management company and you need to figure out how to process a rental application or assign a work order on the maintenance side, what have you. Pull up Notion AI and you just type in, how do I process a rental application? And AI goes in and finds the exact video and serves it up and actually provides you the answer on how to do that. So there's different kind of spots there where AI is helping us as it relates to employee onboarding, employee training, and just making things much more streamlined from an operational standpoint. The other thing that comes to mind is what we do on the leasing side. We primarily do self-showings for all of our apartments, which is something that I think a lot of people are like, really? What are you talking about? But we use a platform called Tenant Turner. When a listing is live and it's on Zillow, it's on apartments.com, wherever, all interested traffic is directed through Tenant Turner, and tenants have the ability, or prospective tenants have the ability, to schedule a showing between 8 a.m. and 8 p.m., right? So it's a 12-hour day, which gives people who are going to work between 9 to 5, when most people or when most companies have their leasing agents on staff and kind of working, we give people the ability to schedule showing outside of that. And then they go there, they get the code to go walk into the apartment. They can walk the apartment. They can take a look at it themselves at their own pace at a time that's convenient for them. And there are security measures behind the scenes. Like, we grab a picture of their credit card and ID, right? So we have we're doing some level of diligence there. They have to go through a preliminary quick background check to make sure that they would qualify for the apartment. Or they have the option to schedule with an agent, right, with one of our leasing agents, and then they can go and accompany them. But we're able to process far more showings in a short amount of time and minimize our overhead from a staff standpoint. And we could probably do 10, 15 showings of an apartment within a 7-day period of time instead of less if we need an individual there, which for us is huge because we manage a bunch of scattered site buildings. If you have a 200 unit apartment community, you can have the leasing agent in there every single day, and it makes sense from a personnel standpoint. But when the same 200 units are spread across 30 or 40 buildings around town, it's really hard to hire for that from a staff standpoint. So we're using a lot of tech on the leasing side, but really just the property management business in general. AppFolio is our PM software. They're doing a lot with AI as it relates to automating different components of the move-in process, the move-out process, the renewal process, the maintenance process, right? A tenant can, even just the leasing process as well. If it's done through AppFolio, they have a lot of AI chatbots where somebody sends a couple messages to a bot or whatever, artificial intelligence, and then it can answer some questions about the apartment. There is parking here, hot water is included or whatever. That's where we're spending a lot of our time adopting new tech. Not really doing too much on the investments business, right? Which is what I define aligned real estate partners, the find deals, the raise money business, outside of some, software to help to kind of help provide updates from an investor standpoint to help the actual capital raise process, e-sign, all that stuff. InvestNext is what we use for that. But PM property management is I think where a lot of those new platforms are being really adopted right now.
Oh, good. That was very insightful. Thanks for going through that, Axel. That's the property management side, because that's one of the things I wondered about with your portfolios as I see them, because the idea of having scattered numbers of small units goes against what was conventional for many years. Like in my time reading Ken McElroy's ABCs of real estate investing, he's a master of multifamily, but one of the first things, especially stuff written in the 90s and early 2000s, is you got to centralize your property management in a way that makes sense. But having these tools to let people view things on their own, having some AI to answer what would be otherwise mundane questions. The Notion, I'm familiar with Notion. We use Monday.com now. We did use Reich before that, but same kind of concepts. I'm a big believer in that. And training people, pulling up those videos, the things that work like that to make sense. And then the last thing you said, well, InvestNext is a good platform. I know those guys out of Detroit used that back when Permanis was one of the first partners, because Michigan based, and they're doing really well now. So glad to see you're using that. So you're fully engaged on the technology front with that, and it makes more sense on the property management side for it to take hold more there first, and then transactionally, as opposed to these big relationships that you have to have with people to, when you're caring for their money. You don't want too many AI bots involved on that side.
Yeah, exactly. And the only other thing too I'll mention, there's a lot of conversation around smart tech within apartments, smart thermostats, smart locks, all of the different kind of fancy upgrades you can make to an apartment. And it's funny is like, I know a couple of guys who run very large management companies or are very large owner operators of Class A real estate. We're talking like big buildings, downtown Boston, where average rents are in the 4,000 plus range. And I've had conversations with them like, you guys doing anything on that front? And they're like, no. And it's very intentional in that they don't a lot of, I think folks, maybe I'm just broadly categorizing people in Silicon Valley or whatever, people who are in the startup community that are trying to identify places to revolutionize the physical aspect of real estate. We can make these upgrades to your stove, your microwave, your thermostat, your lock, your whatever. All that stuff is cool. It's nice, but it makes for management challenges. If it breaks, it increases the operational complexity from a property management standpoint. So I get asked a lot. I was like, are you guys doing anything cool? Like when you're renovating apartments, it's like, no, it's stuff that is tenant proof, that isn't complicated, that's easy to maintain, that does not increase the number of maintenance calls that we're going to get to our property management company. And I think that is actually where it's going to take a very long time for tech to be adopted, because large owners and operators of real estate, large management companies aren't looking to do anything in their apartments that increases the operational complexity. It's just not something that I've personally seen a lot of folks want to do, because it's, we're trying to simplify operations, not further complicate them.
That's interesting. I would have expected a lot of Boston places. Boston is often at the forefront of technical things, right? Historically. So I would expected a few of them to be more on that edge. I know a guy in Kansas City that retrofitted a whole building downtown, and I talked to him extensively because we were thinking about doing it for a 450 unit in Ann Arbor, Michigan, and we went pretty far in depth with how we would do that, and he talked about how, the Internet of Things within inside of it. And I guess if you do it from the start and you do it for a whole building, maybe it can be, in terms of not having to change the locks again, in terms of being able to see when something goes wrong behind the wall, because you have all these sensors in place. But a lot of it is just about having sensors everywhere that tell you when something goes off. So it will be interesting to see how that evolves and which places adopt it or not. But well, thanks for sharing that perspective. I want to ask you now about one of your deals that stands out as maybe one of the best deals so far in your life, where everything just clicked and you're really happy about how it went. And
for sure. Yeah. I mean, I shared some bad ones. I gotta maybe balance it out here with some good ones. Now. So there's one deal that comes to mind that basically took me from a more linear path of growth to, we started to hit more of a hockey stick. I think it was 2019 that we bought. No, it was 2020 that we bought this one. But I connected with an owner through direct email. This is still when I didn't raise capital at the time. I was still very much using a lot of debt, using some creative financing, trying to build a portfolio with my own money. I'd bought a lot of stuff that was, on a deal by deal basis, that was anywhere from 3 to 8 units was the biggest one I had bought at the time. And I connected with this owner who had a portfolio of properties in Manchester, New Hampshire. He had 5 buildings, 27 units was the total unit count. And it was the biggest deal I had looked at individually up to that point. And buildings were very well maintained. He was a great owner from like a physical attention standpoint. There was no deferred maintenance. The buildings themselves were really nice. They were also located in quality neighborhoods, kind of B- class neighborhoods. There was one that was in maybe a C+, but still a good good pocket of that specific neighborhood. And I ended up working him as a lead for 8, 9, 10 months. And finally, the time came for him to sell, because he was just looking to retire and he wanted to sell all of them. But he insisted that he was going to get an appraisal, and that was going to be the price that he wanted to take. And I was like, oh, it's frustrating, right? Because oftentimes I think when somebody gets an appraisal, it's, you have no idea where that number is going to come in. And oftentimes, we've seen plenty of appraisers overvalue buildings, right? Or value them too high comparatively to what the market would pay. However, he hired an appraiser, was somebody local to Manchester, and the appraiser just didn't appraise them well, and appraised them at a price that I was actually willing to pay and that I thought was very compelling. So sent me all the reports. I said, that's fine. I sent him a purchase and sale agreement. And it was a very interesting deal in that I put all of them under their own purchase and sale instead of lumping them into one PSA, so that I could either assign or finance each of them individually or slightly differently. And again, this is one of those deals I had to accept just minimal due diligence. So we walked 2 units in all of the buildings. So I probably, I walked, 14 out of the 27 units and the basements, but I didn't get to see the other ones. I didn't have trailing financials, but I was very comfortable with what it cost to operate real estate in that market. And based on the units I could see and the basements and the exteriors and the common areas, I had a sense of, I knew this was a quality owner. I knew he took care of his buildings. And I didn't really have concern around like getting into the other ones and they're going to be bombshells. And I also had the level of comfort knowing that I was buying this at a very compelling price per unit. So long story short, the total purchase price for all of them was $2.4 million. So it was under $100,000 a unit. And financed them all kinds of different ways. I had one with a ton of private money. I had another one with just hard money debt at 75. And then I had another private investor come in for a second position mortgage. I used banks, just traditional bank debt for 2 of them. And then the third one, I also used private money. I ended up bringing maybe 5% of the purchase price myself to the table. So I didn't bring a lot of personal capital. And I ended up flipping one and did extremely well on the one that I just bought and sold. I basically bought it for $305 and sold it for $500 in under a year. And then the other ones I refinanced, obviously all of my money, I only have 5% in, but they appraised the other properties. Basically, if I were to segment those purchase prices, 24 of the units, I paid 2.1 and they appraised at 3.4. 12 months later. And I pulled out a ton of capital and put a bunch of money in the bank. And I've since sold a couple of those over the years just to roll the equity into, more deals. And then a couple of those I still own now, and they're still, some of the best performing pieces of property that I have. And I probably won't sell them for a while because I have 3.75% interest rate on the debt. So long story short, that was a deal where it was like, yeah, we're doing well. We're doing well. I had rebounded nicely from that bad deal I did a couple years earlier, but that was like, bang, that set me up for, gave me the runway to really grow the business. And it really, kind of solidified the portfolio that had been built. And a few of those buildings were kind of the seed capital once I started selling them to be the co-invest to do some of the larger projects that we had going on, to make some of the key hires in the business. And when I look back at like the pivotal deal that allowed us to really kind of grow quickly, it was that one.
It was that one, huh? Wow. That sounds like a home run. And you didn't walk all the units. You broke one of Joe Fairless's cardinal rules to walk every single unit, but it still worked out for you. You had enough trust in the guys.
We just did a 15 unit deal last week where I walked one out of the 15 units.
Uh-oh.
You know what I think is interesting is, I don't want to go on a tangent, and I don't want to completely, like, when you're doing large deals, when you're doing 100+ unit deals, that's what I define as large here, 10 million plus institutional quality deals. You're basically making levered bets on the macroeconomic situation of that specific marketplace. You're so very rarely buying truly discounted real estate when you're playing at that level, because the deals are brokered by very competent individuals. They're pursued by very competent buyers. They're typically owned by competent sellers. You're not buying a deal at 10, 15, 20% below market value. Do they happen? Sure. But it's like the small 1%, and then especially when you get into the big stuff, 200+ units, there's no margin there, right? You're underwriting to the 10th of a decimal point, and you're competing with incredibly well-capitalized, low cost of capital, intelligent buyers. That market is completely different. I don't even think they're the same asset class. They're really not. From the sub-institutional 5 to 50 unit space, where you're buying from people that are going through, they're just like, I don't want to manage anymore. I have to evict 2 tenants out of the, in this 20 unit building. I don't give a crap. My kids don't want to run it. I'm just going to sell it. I want to sell it now. Like, no one's doing that who owns 150 unit property, right? So a lot of the times the deals that we win and that we do are because of the fact that we're able to play in the gray. And this deal that we bought literally last week, I mean, it's Raymond, New Hampshire. I'm sure you're familiar with Raymond, or know that town. We bought a deal at $85,000 a unit. Like, that's unheard of in New Hampshire. Like, you could be in Berlin, New Hampshire, on the Canadian border, where there's 2,000 people and no jobs, and you're paying $100,000 a unit to buy multifamily. And it's like, yeah, because we can walk one out of the 15 units, and the seller's like, I don't have the keys. My management company is stealing from me. Please get rid of this. I don't want this anymore. It's like, no problem. We can help you. So it's such a different ball game, and I'm always telling people, because there's a lot of people that buy deals that I know that, that are, whether they're New Hampshire, they're probably some folks that are common to both of our networks, and they can't get out of their own way as it relates to, I want to buy killer deals, but I also want all of your financials. I want your tax returns. I want to walk every single unit. I want 75 days to close. I want a 30-day due diligence period. Yes, you could probably find deals, especially if you're looking at small stuff, but you're making it a lot harder on yourself to do that. In order to hit those massive 2x your equity in 1 year type of deals, or your personal equity, or, if you're raising capital to offer those 20+ IRRs and to buy stuff at real meaty discounts, you have to accept some level of risk. Total sidetrack, maybe not what you were hoping to chat about, but something that I'm like pretty passionate about, because
I
those
think
are two different worlds.
I think it is a great point, and we talked about it a lot. I'm a little more of a risk taker than my wife, so I always have been. My wife's the one who has to keep us, she pays all our bills. She's the one that's taking care of the family over the years, and I'm the one like, yeah, let's put it all on red, spin the wheel. So she's always like, she has to rein me in. But I've noticed the same thing over the years. You do have to go out on a limb there. Some people just don't have the composition to do it. Some people are like, every square's got to be checked, and that's the way they are, and that's fine. And some people just succeed that way. They listen to Dave Ramsey. They do whatever Dave Ramsey says, for instance, with their money, and that's definitely a smart way.
And there's nothing wrong with it.
Yeah, they're exactly.
It's just a different approach.
Yeah. And then some people gamble a little more on the edges to an extent, and it's not like you're doing crazy things. You're not speaking of you're not going into casino. You're taking a very calculated risk. And like you said, 8 out of 10 times, it all goes well. One, maybe like this, one might go bad.
Yep.
Sometimes the one that goes bad, like I think of a rehab that I did with a friend and my wife managed it, then it may make you say, oh, I don't want to do this again, because we got a 2-family and we didn't know the people that had been rehabbing it. Just another quick side note, like father and son did a lot of the work and it looked really good, but they did all kinds of weird things. Like they didn't, PVC pipes weren't connected behind the walls. So like there were things that weren't done that it seemed like they were. And then you're like, oh, all of a sudden there's water coming through a wall. You're like, I'm never going to buy into something again. So that would make you say, okay, absolutely, I'm going to get an inspection of every single unit. But like you said, you got to take calculated risk to get the bigger reward. So that's a great point. So I'm glad you made it. I'll give you one more outgoing question. And that is related to financing. And you mentioned some financing stuff. So you could either answer this one of two ways: the creative financing that you've done that's been interesting that people can learn from, as you did in your last deal, or you could just tell us what you're doing today with financing to overcome some of these challenges.
Yeah. So that's a great question. I'll try to go down a road here that might be a little bit more relevant from like a current events kind of standpoint, and not sure when this is going to get released, but I imagine the macro situation here with the real estate market is probably going to be pretty similar. It's really hard to get deals financed right now, and as a quick little data point, for example, back in 2022 or 2021, when we had a deal under contract, and let's say it was a 20 unit deal, it was right down the fairway of what we typically buy in a good area. Financials were fine, assuming that there's no weird variables. That's a deal if we took it to 15 banks, local credit unions, which is who we primarily use for financing on the buy side. We would get 15 term sheets, right? Every single one of them would write a term sheet, and 10 of them probably wouldn't be competitive. 3 of them, we're close. 2 of them, pretty good. And we'll go negotiate with those 2 banks and find the best, rate and terms. Now, if we took it out to those same 15 banks, we're probably getting 5 term sheets. We're getting 10 that are like, we're just, like you, we've worked with you. We appreciate you bringing this to us. You have experience. We're not worried about you as the investor here, but we're just not aggressively lending on these types of deals right now. That's the feedback that we get from a lot of banks. So there's a lot that are just simply not writing term sheets. And then the ones that are writing term sheets are oftentimes including worse terms, naturally. High rates has made the in-place debt service coverage ratio at the time of purchase, when you're buying a value-add deal, extremely challenging to overcome. And it's constraining leverage, which is probably something that most people are familiar with that are in this space. So we still have a few local banks and credit unions that we have long relationships with in terms of doing like a dozen loans, and they're still coming back. And banks are becoming really, really sponsor and investor oriented in terms of who the individual is that's actually personally guaranteeing the debt, 1, in their personal balance sheet, and then 2, who's actually going out there and operating the property and running the deal. So I think that in general, we've really narrowed down the number of banks we work with. And then if we're in a really hairy deal and we can't really go the traditional financing route, we still do go the bridge route. I'm very hesitant to do that nowadays, and I'm really only interested in doing that on deals that either I'm personally buying or that I'm buying with 1 or 2 key partners that have a level of understanding around the business and a level of risk tolerance that they're cool with an 18-month loan product. And typically we're only doing that with deals where we have real big margin. This deal in Raymond I just mentioned was an example, that 15 unit. We kind of had to go that route because we couldn't really go through the traditional appraisal process, et cetera, because we couldn't really access the units. So long story short, that's what we're doing now. And then we're also very heavily pitching seller financing to owners. So again, we do a lot of direct to seller. We're typically presenting 2 offers or even 3 offers. One is, this is the offer this is the price that we'll pay for your property. We're going to go out there. We're going to secure our own financing. But here is this offer, assuming that you hold 70%, 75% of the purchase price back. And we typically, use kind of market terms around the debt, 5% interest only, or I shouldn't say market, but slightly more competitive terms around the actual debt. 5% interest only payments. We'll do a 3-year term, maybe a 1-year extension option at like a higher interest rate, so you're compensated for that. And then we just gauge their interest. Now, the vast majority of sellers aren't interested in doing seller financing because the reason they're selling is they want to take their money and they want to go buy their boat in Florida and hang out. But sure, we still have that conversation. We still pitch it as a potential option. And we're seeing a slightly higher percentage comparatively to a few years ago of sellers that are willing to entertain that. We have one deal right now that we're under contract. That's a seller financing deal. And we're working on another one, and we expect to get under contract tomorrow. So, knock on wood. But that's a $1.8 million deal where the seller's going to hold back $1.5 million for, 24 months. So a couple of years, then we got to pay it off. So
that's a large percentage.
We are starting to get some level of traction there. But in general, it's still predominantly driven by local bank debt, because bridge debt, which was what we used for a long period of time, like a lot of folks, granted we used fixed rate bridge, we weren't using floating rate bridge, is now just so expensive. You're getting into the 10.75, 11.25% range for that debt. And almost just makes sense to go, again, work with a local bank, work with a local credit union or some kind of more permanent stabilized lender, and then just pay a slightly higher pref on your equity if you're raising capital to do it. Your blended cost of capital is a little bit lower, and you're taking less risk because you're taking on less debt, and you're not being a forced seller or refinancer, in a short period of time. So we're only doing that on really, really compelling deals. So I kind of threw a bunch of stuff at you, but that's how we're looking at putting deals together.
It was all good. It was all good. That's why you're our Granite State rock star, Axel. You give me all kinds of good stuff to think about. Anybody who listens to this that plays in this area, especially below the 100 units, they could just dissect this and pause and listen, and then go to your Multifamily Wealth podcast and learn a bunch more. Where else can they reach you? You mentioned it, right? Host of the Multifamily Wealth Podcast, coming up on 250 episodes. We've been cranking it away for 5 years now. 30,000 monthly listeners. We have a lot of folks listening to it. So if you like if you like multifamily and you want to learn more about multifamily, go check that out. You can follow me on Instagram. I'm very active on Instagram at Multifamily Wealth. And then if you just want to reach out to me, Axel, AXEL at alignedrep.com. So ALIGNED-REP.com. Excellent. Thanks again, Axel. It's always good talking to you. I'm glad you took some time today to hang out with us, and I'll let you go. Hey, thanks for having me on. If anybody else wants to find out more about what we're doing, please come to froggycompanies.com. Check out our 3 different business areas. We also have the Froggy Fund 1 that's now open for up to $18 million. We're going to be investing that $18 million across a diverse number of assets, cash flowing and ground up. And I'm really excited about this fund, and really confident that we can outperform most of the other people out there in terms of what we invest in and how we do our due diligence and the type of partners we put together. So it's great talking to you, and see you next time.